Hey, everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday, where each week I'm going to take the most important mortgage and housing data. I'm going to break it down in a few different ways. So, first of all, I'm going to give you the cliff notes for my friends who just want to know what time it is. Then we'll go a little bit deeper for my friends that like to know how the clock works. And I've even got a clock builder session for those that just have to know how the clock is actually built. And stick around because this is a big data week. Let's go ahead and get into it. Here's the short version for my friends that just want to know what time it is. The Federal Reserve did cut the Fed funds rate by 0.25%, but mortgage rates didn't magically drop because mortgage rates are driven by the bond market, not the Fed funds rate. Now, the Fed is internally divided, and Powell made it really, really clear once again that there's no risk free path forward, meaning that future cuts are just not guaranteed. The labor market's cooling, even though the headlines still look okay, and hiring quits are near multi year lows. Layoffs are rising, and worker confidence is fading. So, this, like I said, it's a massive data week. We've got the jobs report tomorrow, we've got CPI on Thursday, and this data could set the tone through early January. Markets believe that the jobs report could come in a little bit weaker than expected, which would be pretty bond friendly and potentially helpful for lower mortgage rates as well. Now, before we go any further, let's go ahead and talk about mortgage rates because I know that's why most of you all are here. So, as of this week or close of business on Friday, the national average for mortgage rates, according to Mortgage News Daily, they were 6.29% for a 30-year fixed rate, 5.76 for the 15-year, 5.88 for a 30-year FHA, and 5.9 for a 30-year VA. Now, and this part really matters. These are national averages. These may or may not be your rate. Your actual rate could be higher or lower depending on a handful of different factors like your credit score, your down payment, what kind of equity you have, whether or not you're going to live in the home, how big your loan size is, and believe it or not, how the bond market actually behaves between now and your loan closing. All of those things are going to have a big impact on that rate. Now, rates don't just exist in a vacuum. They're built day by day based on the bond market and all the other things that are going on nationally and globally. So here's how we're handling the strategy for this week. If you're closing in the next 15 days and you're working with a certified mortgage advisor or somebody who truly understands the market, we're advising carefully floating. But again, only if you're working with somebody who actively watches the bond market and understands how it affects mortgage rates and how to react quickly. Now, if that's not the case, you might consider locking. That is a safer move, especially if you've got low risk tolerance. Now, if you're 15 days or more out on either a purchase or a refinance, floating makes sense right now, especially with major jobs reports and inflation data that's going to be hitting this week that we do believe could be bond friendly. So, this is not about guessing, it's all about risk management and timing. So, hey, that's it for everybody who just wants to know what time it is. Now, for my friends who like to know how the clock works, let's go ahead and slow this thing down a little bit. And I'm going to actually explain what's happening. The Federal Reserve, they did cut that Fed funds rate by 25 basis points or 0.25%. And now they're at that range of 3.5 to 3.75. And this was their third cut of the year. Now, remember this, the Fed funds rate, it's the rate that banks charge each other when they lend money to each other overnight. Now, it does not directly set mortgage rates. Mortgage rates are driven by mortgage-backed security prices, and those prices are affected by inflation expectations, labor market data, economic growth, and overall risk sentiment. Now, even more important, this cut wasn't unanimous. One governor wanted an even bigger cut. There was two that didn't want to cut at all, and 6 of 19 officials wanted to pretty much hold steady. That tells you one thing. The Fed just isn't confident yet, at least in terms of inflation being broken, and that we won't have some kind of a surge in labor market weakness. So, Fed Chair Powell, he's pretty much repeatedly said over the last few months that there's no risk free path forward. And that translation is that they just need hard evidence that inflation's cooling and that the labor market is weakening before they move any further. So, yes, job openings did tick a little bit higher, but don't fall for the headline. Job openings are still far below the 2022 peak. And those details matter even more. Hiring rates, they're near the lowest since 2011. Quit rates are the lowest since 2014. Layoffs are at the highest level they've been since 2023. And the job openings to unemployed workers that used to be two job openings for every one employed worker, it's down to one job opening for every one employed worker. That's a cooling labor market, period. Now, tomorrow's BLS report, it's expected to show somewhere between 40 and 50,000 new jobs, but a lot of the private data sources, they suggest it could come in quite a bit weaker. Even Powell admitted that the BLS, they may have been overstating jobs by about 60,000 per month. And yes, that matters. And here's what the bond market really cares about right now. It's wages. Wages have been decelerating. ADP confirms it, Employment Cost Index confirms it. Hourly earnings expected to fall from 3.8 to 3.6. Lower wage growth, lower wage growth equals less inflation pressure, and less inflation pressure is bond friendly and ultimately mortgage rate friendly. That's why bonds are a little bit higher today and why this week matters so much. So, hey, everybody, if this content's helpful to you, please help a local guy out and like and subscribe. If you've got suggestions for any other content that you'd like to see, make sure and send that. It really does help. It makes a big difference. All right, for my friends who really want to know how to build the clock, let's go ahead and clear up one of the biggest misunderstood concepts in finance, and that is the Fed funds rate. Now, every time the Fed cuts rates, my phone blows up with text messages saying, Doug, mortgage rates are dropping tomorrow, right? Wrong. Not exactly. The Fed funds rate, it's the interest rate that banks charge each other for overnight loans. That's it. It's not your mortgage rate, it's not your car loan rate, and it's not what banks charge consumers directly. It exists because banks are required to hold a certain amount of money in reserves every night. One of the safeguards that actually came from the whole too big to fail era. Now, some banks at the end of the day, they close out with extra cash, while others end their day a little bit short. So, for the ones that end up the day a little bit short, instead of freezing lending or panicking, banks actually lend to each other overnight, and they do it at the Fed funds rate. That keeps the plumbing of the whole financial system moving. The Federal Reserve doesn't set mortgage rates, it just kind of sets the temperature of the room. By raising or lowering that Fed funds rate, it influences how expensive it is for banks to borrow, how willing banks are to actually lend, and how much money flows through the economy. Higher Fed funds rate, well, that equals tighter money in a slowing economy. Lower Fed funds rate equals easier money, more borrowing, and kind of a booming economy. Think of it like a dimmer switch, not an on off button. Mortgage rates, on the other hand, these are long term loans, 15 and 30-year loans, and they're priced directly off the bond market. Bond investors care about inflation over time, economic growth over time, and risk over time. So while the Fed funds rate affects the front end of the economy, mortgage rates live on the long or the back end. And what we're seeing today, we're just seeing two different clocks hanging on the same wall. So here's the bottom line. The economy isn't breaking, it's transitioning. The labor market isn't collapsing, it's cooling. An opportunity still exists for people who stay disciplined and informed. So if you're buying, refinancing, or just trying to understand your options, don't guess. Have a plan. Hey, everybody, that's it for this week. And don't forget, if you're already in the home loan process and you're not getting this kind of content or advice, it's not too late. Just shoot me your loan estimate, and I'm glad to analyze it for you and make any suggestions that I can that might help you or you and your family. I'm here for you during office hours, of course, but I'm also here for you by appointment on nights and weekends. We'll do whatever we can to help. And as always, if you're military, law enforcement, or a firefighter, our commitment to you through the Shoemaker Loan Team and the Home Foundation, it's real, it's measurable, and it's ongoing. Hey, everybody, thanks so much for being here today, and I'll see you next week.